The past week has seen significant movement in SoFi stock, with a drop of around 11% at the time of this discussion. Hello everyone, welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But before that, alert, this is not a financial advice video. The broader market sentiment remains shaky due to concerns over tariffs, and pre-market futures could be reflecting heightened uncertainty. However, history provides a valuable perspective. If we look back to 2018, there was considerable anxiety over trade tensions with China. Yet since that point, the Nasdaq has surged by 260%. Similarly, during the pandemic in March 2020, a crisis far more severe than the current tariff situation, the Nasdaq still managed to climb over 200%. Short-term volatility is inevitable, but the key is to maintain focus on the long-term trajectory of strong companies. Given that market sentiment can shift rapidly, today's concerns could fade within a week, and we might see a completely different narrative emerge. Often, these trade tensions serve as leverage for negotiations rather than a sign of deep, prolonged economic distress. But putting broader market anxieties aside, let's take a closer look at SoFi's current position and the aspects that investors should focus on. At the moment, SoFi is trading at approximately 1560s with a market capitalization of $17.28 billion. Despite the recent dip about 12%, its year-over-year performance remains robust with an 87.86% gain. In just the past 6 months, the stock has soared by triple digits, making short-term declines seem far less concerning in the grand scheme of things. Looking at valuation metrics, SoFi's forward price-to-earnings PE ratio is currently around 63.5. Fiscal year 2025 earnings per share, EPS, are projected at 25 cents, while fiscal year 2026 estimates stand at 46 cents. Management has indicated expectations around 67 to 68, suggesting that analyst estimates might be on the conservative side. It's important not to make investment decisions based purely on pricing metrics, as these are often based on forecasts that can shift over time. At present, the average analyst price target for SoFi is approximately 15% lower than its current price, which may appear discouraging. However, focusing too much on quarterly earnings and short-term outlooks can sometimes lead to overlooking the broader strategy. Management has reiterated its commitment to achieving 20 to 25% compounded annual revenue growth through 2026, and beyond that, they foresee annual EPS growth of 20 to 25%. These long-term projections suggest that the company is on a solid path. A key takeaway from recent earnings is that SoFi consistently underestimates its own performance. This has been observed in 2024 and is happening again with 2025 projections. One reason behind the tempered guidance is the company's decision to reinvest more into its business, temporarily sacrificing profitability for long-term expansion. This explains why revenue is on the rise while near-term earnings expectations appear slightly lower than anticipated. What stands out is SoFi's ability to control its profitability. They've demonstrated flexibility, prioritizing growth when necessary and tightening margins when needed. This level of financial control is a strong indicator of management's strategic capabilities. Examining business segments, SoFi has seen exceptional growth in lending revenue and financial services, while its technology platform has exhibited slower expansion. However, management has announced initiatives that will primarily impact 2026 and beyond, meaning we may not see the full benefits for another year. As long as the key growth areas, particularly financial services, continue to scale, the overall business outlook remains positive. CEO Anthony Noto highlighted in the earnings call that in 2023, SoFi set guidance with a 30% incremental EBITDA margin. The company took a conservative stance last year, factoring in potential macroeconomic headwinds such as inflation, interest rates, and geopolitical uncertainties. This cautious approach allowed them to expand margins at the expense of revenue growth, ultimately delivering over 30% incremental EBITDA margins. Now, for 2025, they are shifting their focus back toward revenue expansion while maintaining long-term profitability targets. One particularly promising development is SoFi's loan platform business. The CFO recently disclosed a $5 billion loan platform business contract, demonstrating the growing importance of this segment. Over the last year, the loan platform business originated $2.1 billion in personal loans, with fee-based revenue increasing by 74% year over year. This segment generated $63.2 million in loan platform fees in the latest quarter, fueled by $1.1 billion in personal loan volume. These numbers suggest strong momentum in a business line that is crucial for SoFi's long-term profitability. An interesting insight from the earnings call came when an analyst inquired about the potential for SoFi to shift entirely to a loan platform model. CEO Anthony Noto acknowledged that this is a possibility, given the attractive economics of fee-based revenue. Such a move would allow SoFi to operate with a lighter balance sheet, lower credit risk, and faster capital turnover, essentially increasing efficiency and reducing exposure to lending risks. Beyond lending, SoFi is also looking at new opportunities, including the cryptocurrency space. While regulatory challenges exist, management has stated that they plan to be aggressive in expanding their crypto-related offerings. This could potentially mean moving beyond simple crypto trading and into areas such as custody services, similar to what Coinbase is currently doing. Turning to SoFi's technology platform, the company expects revenue to grow in the low double digits to mid-teens in 2025. Implementation cycles have been longer than anticipated, leading to a slightly lower projected compound annual growth rate (CAGR) of mid-teens from 2023 to 2026. Despite these adjustments, management remains optimistic about long-term expansion. Financial services, a rapidly growing segment, is currently operating at approximately 45% margins, with annualized revenue per product at $81. Management believes there is still room for greater monetization, particularly within the investment side of the platform. Additionally, the loan platform business, which falls under financial services rather than lending, is generating margins above 50%, highlighting its growing profitability. Contribution profit trends indicate strong progress, with lending and financial services both exhibiting upward trajectories. While the tech platform has been relatively flat, financial services are expanding rapidly, growing nearly fivefold year over year. Despite some investors focusing on near-term guidance and reacting negatively to lower-than-expected projections for Q1 and fiscal 2025, the bigger picture remains intact. Over the last 6 months alone, SoFi stock has risen by more than 100%. The company prioritized profitability in 2024, is emphasizing revenue growth in 2025, and is on track to meet its 2026 targets. Even with shifting market conditions and strategic adjustments, management's ability to maintain its long-term outlook underscores the company's resilience. Technically speaking, SoFi stock is currently below its 20-day moving average, and with market turbulence surrounding tariff concerns, it could dip further. If the stock were to fall below the 50-day moving average, we might see levels similar to 2 weeks ago, around $14. If it drops to the 200-day moving average, which is approximately $11, that could present a strong buying opportunity for long-term investors. However, market conditions remain fluid, especially as earnings season progresses, with companies like PayPal, Uber, Alphabet, and Amazon set to report results in the coming days. In summary, while short-term fluctuations can create uncertainty, SoFi's long-term growth strategy remains robust. The company is making strategic investments in high-margin areas, maintaining financial discipline, and expanding its revenue streams. Investors who focus on the big picture rather than temporary market reactions are likely to find SoFi's long-term prospects compelling. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.